Well, that's what I was going to say. It sounds like you are on this bear market watch, but you're not sounding an alarm right now.
That's a great way to put it. It's watch, because sometimes these things resolve themselves, and you can move higher. But for example, from 2009 lows, whenever we got a pause, we'd break out of it what we call a breadth thrust. We get a huge percentage of stocks moving up together, and that's the sign of a very healthy market. And we haven't gotten one since the February correction. So that's a change in character. Again, doesn't mean the market can't rally for a while, but that's what happens at the end of a bull market, not at the beginning of a bull market.
What do you think could take us down? What do you think the catalyst could be?
Yeah, our primary list of concerns is on the earnings front, because by the time you get these kinds of great numbers, the market starts to look forward. Earnings growth north of 20% isn't sustainable, especially when you're 9 years into an economic expansion. And then the other thing that really concerns us is if for some reason the Fed were to have to accelerate its tightening cycle, that could be a problem, because one of the big underpinnings for stocks over the last several years is that no matter how expensive they are, they've still been cheaper than bonds.
Ed, when you look at the market right now near these record highs, what do you think the worst case scenario could be this year?
Yeah, this year I think that we're somewhat limited to the downside, because the worst bear markets have all been associated with economic recessions, and those signs are few and far between, despite what some people would scare you with the yield curve or something like that. So the worst declines ex recession tend to be in the mid-teens, maybe to 20%. I'm not even sure we're going to need to get that low this year. More of a kind of a trading range environment. Maybe the February lows would be the worst of what we'd be looking at this year.
Hey, Ed, I want to jump in here from Chicago. It's Jeff Kilberg, and we certainly have seen the market move higher. Complacency seems to have crept back into the market with the VIX at 11. What is your major concern to prevent us from making new all-time highs? Is it interest rates, or is it more this political tension that's kind of brewing up with these newly reinstated sanctions on Iran, which is a proxy to China?
It's interesting from a sentiment standpoint. We have sentiment composites we follow. The VIX is actually one of the inputs, but overall, these trade war fears have actually helped the market, because they haven't had a major impact on the fundamentals yet, but they certainly have been something to talk about, and I think have held us back from getting to these excessive optimism levels that have been problematic in the past. So it's a wall of worry.
Ed, it's Scott in Chicago. I have a question. You mentioned a bunch of the sectors that are doing well now, and they're boring sectors. But doesn't that indicate that we're actually in a pretty healthy market, since we're no longer relying on just names like Netflix and Facebook to get to new all-time highs?
Well, if it can resolve itself in a healthy way, that is, it's more like every sector has its chance to go through a corrective phase and move higher, then we can look back and say that's the case. But usually when you get to the end of a bull market, the leadership starts to turn a little bit more defensive. So that's a warning sign. Again, it's not a definitive answer, but that's our fear that's what this is marching towards. But it certainly is different, you're right, than having just the FANGs do most of the heavy lifting. It is nice to see some other names holding in there as well.
Ed, before we let you go, real quick, quantify for me how steep of a decline you think we could see. What kind of a correction?
So, yeah, I think in terms of this year, I think the February lows are probably the risk we want to keep an eye on. I think as we move into next year, the risk is for a bigger type of decline, because, again, the earnings story could be very different. The Fed policy could be quite different. And then you could be looking at the first 20% plus decline in the S&P since the financial crisis.
Exactly how big on a percentage basis, do you think?
Well, again, if we're not looking at a major recession, you're probably looking at 25, maybe 30% would be what we'd be thinking about at that point, not like the 08 or 2000, 2002 declines.
All right, we're going to leave it there. Ed Clissold, great to talk to you. Thanks so much.